We have two very special guests joining us at the desk today. Gareth Nicholson is CIO of CIO International Wealth Management at Nomura, and Florian Windiger is CIO at Santa Lucia Asset Management. So this is going to be a four-way discussion. Lovely to have both of you on the panel this morning.
Thank you.
Great topic of discussion. I think it's very topical. Let me start with you, Gareth, in terms of what you're seeing with this narrative, because the sense is that in the last few months, India has lost $20 billion of foreign institutional, in terms of foreign institutional outflows, and a lot of that money has gone into Chinese tech and essentially Chinese equities.
Well, for us, if we zoom out for a second, the biggest theme at the moment is geopolitics, right? And actually, that is something that's difficult to trade on. What we do like trading on this idea of local champions. So if deglobalization started before Trump and has been really supercharged during Trump, we're going to have to find local champions. And two big areas, China and India, can find their local champions. So we think there's opportunities in both. But arguably, China has run up that in the past, maybe 6 months ago, it was very difficult to justify at some of these costs that these local champions are going to be able to keep powering through. Whilst on the other end, China has been very undervalued. From a valuation perspective, it's been really struggling. So what we're seeing at the moment, we're still seeing India being the darling of Asia. With regards to international investors, US and Europeans still prefer investing in India than they do in China. But the valuation in China and some of the stimulus starting to build green roots is making it very exciting. And we're starting to see tactical trades coming in, particularly around tech, particularly around some of the manufacturing that where we're seeing some of the index numbers coming through. So it is a mixed bag. For us, we still like both. We want local champions, but we prefer China today over India for sure. We think there is a lot more growth in China in the short term in the markets than India.
Florian, do you agree?
Yeah, I mean, this is probably not going to turn out into a boxing match because we're also a bit more measured on this. But maybe just taking a step back, I think market participants are often a bit too focused on what foreigners are doing, because in both markets, actually, what locals are doing is what's really driving these two markets. And if you look at the numbers, I think US money in Chinese equity markets is about $800 billion or so. India had seen significant foreign outflow over the last year, sort of stagnation and then outflow in the last second half. And even over the last month, if you look at the Goldman Sachs data, it seems to be a hedge fund repositioning over the last few weeks into China. So I'm not entirely sure that it's really the foreigners. I think it's a lot the domestic. If you look at, for example, the Southbound Connect data, which expresses mainland investors going to Hong Kong, that's been running at over 20% of volume already towards the tail end of last year. Again, this year, I can't remember which day it was, but there was a day in February which was the highest ever inflow day. So it's really, I think, the animal spirits of the local investors that really matter. And we remain positioned. You might remember from other episodes of the show together. We do like the opportunity in China from a value perspective. We have almost half of our Pan-Asian portfolio in China, especially the SOEs. But we had a lot of India, and I was scolded live on this show when I shared early last year that we're taking down India from over 20% to around 7%.
Yeah.
And
because you said you were bringing it down half, and you made it seem like just a casual passing statement, and I was like, that's half of your portfolio down in India, Florian.
But I'm happy to share with you today, and I'm having my Indian chai with me from home. We have been buying more India over the last few weeks, because some valuations have actually returned to interesting levels again. I think the headline Nifty valuation that you showed on screen is actually only showing the surface. Below the surface, some of the mid-cap valuations have really fallen out of bed post of September, and some of those stocks are starting to be in our range again. As you will remember, we are a very stingy value investor. But even our price discipline is starting to fade with some of the opportunities we're seeing in some of the Indian mid-caps now. But that's a year hence since I was scolded on air.
Maybe I can jump in there, because I think it's a really interesting point, the idea of locals buying the stock market. Because, as you said, when the locals are buying, that creates that sticky money. I mean, I'm in China next week, and what I'm most excited for is to see what the taxi drivers are doing. 5 years ago, when the taxi drivers had 3 screens on their, still trying to drive, got 3 trading screens up there, then you know that the locals are really buying, that they've got involved. The last few times I've been there, you haven't seen that local buying. Yes, you've seen the flow coming through, but when you really have locals locals buying the market, then that takes away the dips. That creates confidence for asset managers, for insurance to start moving in. And then we're going to see the gap between, for instance, the big seven and China tech really start closing because they build their confidence. We're not seeing that confidence yet from the locals, where India's had that for a long time. India buying India. But our Dubai office, who deals a lot with our Indian clients, they haven't been as interested to get back into India. They're actually talking more about where can we look at private markets, where can we look at other spaces. So I don't think we have that momentum just yet with locals buying local. When we see that, then I think we're going to get European money coming in. We're going to get more Asian money. That's going to be the big catalyst.
I think you make an interesting point there, and Sam, we could go there as well for a moment. But I was talking to somebody, an India expert, and he also said that the retailers in India have been a bit shaken by the kind of outflow that foreigners that they've seen on foreign institutional flows, and so it's not just profit taking, but it's also the underlying growth story. They're not sure whether this is cyclical or structural, and so they're a bit wary because the market had run up so much. So do you not think that also the local story is somewhat also related to how foreigners feel about a particular region from an investment standpoint?
Absolutely. I mean, not to be overly simplistic, but psychology and animal spirits matter, and we're seeing that in China right now. People are chasing the story again, for the right or the wrong reasons we can debate later. But people are chasing the story again, and in India, I think it also combines with, this budget sort of came in as expected, but had a lot of sort of goodies, I think, for the middle class intended, and part of that, I think, is a reflection that consumer balance sheets in India are not as good as they may have been. And so that combines with a stock market dipping, that's not a good configuration, right? So, and because very often the stock market rally can create a wrong sense of wealth. And I think that's what people are responding to. But we're also entering maybe a new phase in India because with the interest rate cut, which I think was the first cut in 5 years or something like that. Which may change what people are looking for in the market. I remain quite incredulous how there's a big segment of the Indian stock market that, well, not big, but a growing segment of the Indian stock market, which is the investment trust, infrastructure investment trust segment, where you have assets trading at 12% IRRs with government guaranteed revenues, which is just the wrong price. And yet people are chasing, future growth at very high multiples. But as rates come down, that sort of internal market preference could also shift as people start to sort of question, do I really chase that consumer stock at 50 times earnings, or do I start to reflect on cash flows?
Okay. Yeah, you both make fascinating points. I mean, the anecdotal evidence from China as far as what the taxi drivers are up to, is great color. And, that's certainly something that I look at when I do get my limited access over to the mainland. But and you made a fascinating point as well, and that is exactly what I was thinking about when you were talking, is it's all up here, isn't it? It's purely psychological, particularly when a lot of this activity is driven by those retail investors. I do want to talk about some of the southbound flows, as you pointed out, because we were talking to Jason Liu about that in the last hour, and he was saying that it's largely been driven by what we're obviously seeing with regards to tech and sort of pumping into those sort of bigger names, like your Alibaba's diversification for mainland investors. But then, some of the more sort of cynical ones out there who, maybe, not buying that story completely, do believe that maybe it's a bit of Team China at work, or even perhaps even a bit of capital flight based on some of the economic malaise in China as well, sort of boosting Hong Kong. So, I mean, we have to sort of make that distinction between the outperformance on the H shares versus the A shares as well. I mean, is that what you're sort of seeing? I mean, what do you think is behind, a lot of that southbound flow?
Well, I mean, we think that, H shares are cheaper. It is rational to buy H, not A, because even the same company, and in our portfolio, we have several of these examples, sometimes trades at a very big discount. I mean, we have some companies that where A trades at double the price and, half the dividend yield. And mainland investors are starting to become more sophisticated. In fact, if anything, over the last few years, the mainland investor has been very discerning, even though now, of course, the mainland investor in the last few weeks has been driven by the animal spirits, but it's been quite discerning. And the Chinese government is actually supporting that. The Chinese government has, over the last 2 years, there was a circular, I think it was November 22, I hope I get the year right, but I think it was November 22 when there was a circular coming out where the government and the CSRC are basically saying the HA discount is a sign of non-well-functioning capital markets, and we are going to do something about it. And so, and I think the other piece here is I don't think that H is necessarily capital flight, because it is a closed-loop system, right? You, as a mainlander, you go into the southbound Connect. When you sell that southbound Connect share, it gets straight booked into your RMB bank account again. So southbound does not represent capital flight. I think that's a misconception sometimes out there.
Okay.
And so we think it's rational flows that are actually very much with the blessing of the government. The government wants more integration between China and Hong Kong.
DeepSeek disruption. It almost like came and hit us from nowhere and made investors realize that Chinese tech has arrived as far as their AI plans are concerned. Do you think that has more legs, that story? And how far does it take Chinese tech? Because when Alibaba announced its CapEx plans, or when Trump announced the US first investment policy, it obviously it led to that sell-off in Alibaba, but then it bounced back from there. So do you think investors are convinced that from a risk-reward perspective, Chinese tech has made a mark?
Well, for us, it needs to be where's the support coming from locally. You highlighted that the government is really, really constructive in building the economy. Which we really like too is we're seeing that the government is not looking to pick fights with Donald Trump. We're actually hearing less tariff talk and policy talk from China and the US, because I think the US is just keeping quiet. They're focusing on growing their economy again, making sure that the trading is strong, finding their champions, their local champions in the space, and building that up, and letting Trump find where he wants to pick his fights. At the moment, he's picking his fights in Europe, he's picking his fights in in Canada, and it's relatively quiet compared to what it could be. That is interesting, because that means they're focusing on where can we grow. And DeepSeek was a prime example where if you're constrained, you're in a box, you can be very innovative. You can see kids, you lock them in their room, not lock them in the room, but you say stay in their room. The things they get up to is crazy. When you have constraints, you can look for innovations, and they've proven that. And it was really interesting what they could do with this space. And I think that's just highlighting that AI is in the infancy stage. AI is in the refrigeration stage. We need to get Coca-Cola to come in, use the refrigerator, and expand. And DeepSeek's an example where you can use AI in so many industries, because you don't have to spend so much on specific knowledge bases.
It's raised the issue of affordable innovation. And we were making the point, of course, about how, DeepSeek has been a disruptive moment, not just for the world, but also internally for China in terms of where they go with their AI revolution. But just, your thoughts on where India stands when it comes to this whole AI race, this whole AI debate, where they're saying, okay, the US is going to lead it in the West, China's going to lead it in the East, but where does India fit in? Because it seems like they're trying to balance the equations. Yes, they're getting closer to the US, but they're also kind of, like we just discussed, thawing relations on the border front and bilateral relations with China, just to keep things a little bit balanced, Gareth.
Well, I think India's still fascinating, right? I think there's more US developers in India than there is in the US. I saw that number recently. For most of the companies, lots of the developers are still there. And yes, programming can be done largely by AI now, but you still need those minds at the moment to help think of the next innovation, the solutions, to use the tool. AI is a tool. So we think there's huge potential for innovation in India. There's a huge amount of capex that's still going into the space. There's a huge population that's growing that can use this technology. And if you have now the ability to use AI at smaller scale to expand it out in many, many different industries, it doesn't have to be huge language models, expensive ones for it to work. I think there's a lot of scope still for the India space. But the ecosystem is nowhere near as developed as the US or China. So that's going to take a long time, right?
Exactly. And they also talk about how India may do well on the software front, but on the hardware front, India, again, doesn't have that ecosystem, Florian, to take that story forward.
Well, there was a fascinating chart, and I can't quite get the numbers probably exactly together, but India has a significant opportunity as a contributor, as a picks and shovels trade, so to say. India is also at the intersection of some very interesting undersea data cables. I think the statistic was something like that, sort of 20% of traffic is flowing, but India is only sort of covering 3% of the need. But India has a real opportunity. to participate in that, just given its geographic location, in particular as the Middle East and China are developing closer relationships. And it's not just India who is looking for its own answer to AI and its own role in that. Many other countries of the global south are having the same question. And what DeepSeek, I think, has shown is that it is within reach for everybody to have their, as you said, affordable innovation. I think that's part of China's strategy, is to create an ecosystem where they can share with their friends. And China has been very much in the business of making friends over the last few years. This is where all of China's exports growth has gone into, right, in the global south. And India will, if China can do it, India also can. But I think, as you said, the hardware thing will take quite a bit longer.
So can we apply that school of thought then to the whole India becoming a beneficiary of diversification of markets over in China with regards to the whole tariff argument as well? I mean, with regards to India having the potential but just not quite there yet.
Well, I think what we're seeing is we're seeing that deglobalization means each group has to have their own resilience. That's tech resilience, that's defense, that's energy, and big places like India has their own big enough domestic economy to do this. But tech was out of reach. It was just thought it's such an expensive pace to build this up. We are seeing a lot more investment going into India, so they have their own tech resilience. They have their own energy resilience. So that is going to be a beneficiary, because when investors are looking for opportunities for local champions, India has been a place that a lot of foreign investment have gone to. So now if you have the catalyst of, okay, the government is behind building resilience in tech, in energy, so they're going to be supportive. We're happy to bring our funding in. We're seeing a lot more private markets, private deals, private credit going into the space to help build that infrastructure up, because there is a huge gap, as highlighted. So I think that's the opportunity, is the catch-up trade. I don't think the opportunity is cutting-edge next DeepSeek coming out of India. I think it's the catch-up trade. There is enough growth there. There is enough scale. Geographically, there's opportunities. So I think that is where, for us today, the opportunity is, instead of looking for the latest tech coming from them. It's much more going to be a China-US story.
Okay, on that note, should we bring up the chart? I mean, the year-to-date returns in US dollars when it comes to India and China. If we can bring up that chart, I mean, it's fascinating as far as what we're seeing here year-to-date just of this week. I mean, China outperforming, as well as the Eurozone, which I found quite interesting. But then you've got the Mag 7 and India lagging almost in line with each other, and then the US Mag 7 too. Basically, China dwarfing that. I mean, what do you make of that?
One should add to that chart maybe that last year Chinese equities kept pace with US equities. Most people seem to be in complete denial of that fact. So 2024, Chinese equities kept pace with US equities. You can pick your measure, Nasdaq, S&P, Hang Seng China Enterprise, Hang Seng, and so on. But we are, in broad terms, Chinese equities kept pace. And what we're seeing here is sort of a continuation of China rebounding from very low valuations. Just overnight, the trading action overnight in the US market is sort of a confirmation again of what we're seeing on the screen here, right? It's very tricky to follow indices right now, because underneath the indices a lot of different movements are happening, right? Sort of a lot of US tech down overnight, but actually a good chunk, maybe even half the S&P names are actually sort of flattish or up, but still the market is down. So a lot of market internals where the sort of the tectonic plates of the market are shifting at the moment.
Gareth, your observation?
Maybe it's also worth noticing there. I mean, that's only 2 months, right? It feels like it's been a lot longer year, 2025.
I know.
It does.
Tell us about it.
But, I mean, fundamentally, growth has kind of been sideways. Inflation's kind of been sideways. There hasn't been major things. But what we have seen, particularly if you look at the ones that are outstanding there, Europe and China, are two where the central banks and the governments are very scared. And markets love when central banks and governments are scared. They start spending lots of money. Europe is spending a huge amount of money. The fundamentals aren't there, but we're seeing the money go there, and that's what's arguably driving the momentum. China has been building the stimulus up and highlighting. India hasn't really. India's been relatively quiet. The budget's come out quite constructive, so I think that's going to be a change. And I think whilst tariffs, and if you actually look at tariffs, China and India and Mexico are the three largest that are facing net tariffs between the two. So I think there's a lot of pressure on India, a lot of pressure for the government to show that they're going to support the growth. That is coming through, probably needs a little bit more. But whilst there is fear in the market and banks are looking for, bankers and investors are looking for central banks to show their support, and particularly politicians, it's definitely going to be China over India at the moment.
China over India at the moment, clearly for you. Yeah, and honestly, the screen is telling you that. The screen is telling you that in terms of the total returns and what we just flagged. Where is the money opportunity? Where's the investment opportunity when it comes to India? Because we've had a very, very robust IPO pipeline, even this year with Reliance Jio and the National Stock Exchange coming to the markets. There is a sense that retail investors want to get into IPOs than get into the secondary market or get into the secondary market via the IPO route. So investment opportunities that you size up in India, which still offer favorable risk and reward, especially if the consumption boost kicks in.
We're feeling that we have to dive in deep into India. We're not playing the beta trade anymore. We're not playing just try get in and ride the economical growth, this kind of darling of Asia. We're liking much more private markets. We're liking to look at fund managers that are really niche and focusing on specific sectors. It's not really about buying the Nifty as a general kind of ETF approach. Is really getting involved there. So we're spending a lot more time on the ground trying to understand where it is. You talked about trust and infrastructure and building up those opportunities. So again, it comes down to how is India going to build their resilience, get their government support? So energy, infrastructure, tech ability, these are spaces. We're seeing a lot of banks outsource into India. So that's being a big shift. So there's a lot of those businesses that are growing. But India it's a lot harder to make the easy money. India's been a fantastic trade. If you take that chart back 10 years, it's very different. India's been fantastic. So don't get me wrong, the Indian investors have maybe taken some money off, but they're still well in the money. They are looking for an opportunity to buy. We're looking for where they're going to start buying, where they see the next. And when we talk to our big clients in India, they're looking for niche opportunities. They're looking for where we're going to see the next infrastructure deal, where we're going to see the next business which is going to help grow India Inc. So it's a lot more tactical in India than it was over the last 5 years.
And given that you're already buying, Florian, we're speaking to people who are saying right now, given the uncertainty with the underlying macro environment, maybe you need to wait it out for a few more months because there might be more downside to the market opening up. But you're already throwing your hat in the ring and you've started buying. So what's the conviction and what are you buying and why are you buying that?
Yeah, I mean, it's adding marginally on top of our existing sort of 7% allocation to India, and we're very bottom-up driven. So whatever we do is usually a reflection of where there are sort of dislocated opportunities. It's less a reflection of would I buy the stock index here. We've seen a significant shift down in especially the mid-cap stocks, which have deteriorated by a lot more than the index. We like the road infrastructure INVITs. Many of them just receive availability payments from the government. Traffic is insured, therefore, essentially, or for a big part of the revenue, and they're trading at 12% IRRs. So I know it's not the best trade of the century, but it's just the wrong price. And there's a debate whether the price for the other things is right. Yeah. And then on sort of the more mainstream, we do like the power sector as an interesting opportunity in India. We like ONGC, a company that's adopting more and more market pricing through the products that are flowing through that company, but also are adopting more and more and have actually, to give them credit, adopted very much sort of world-class management practices. And I think that was on display at their last investor day. We're sort of marginally increasing at the moment. I think we've increased by 100 basis points or so our India exposure over the last few weeks. So we're slowly getting in there. But we've bought our first Indian equities after a long break.
Okay. We need to wrap up the discussion. So very quickly, I want to get in closing thoughts on the macro, market, and currency situation. Florian, I'll let you go first. On India versus China at this stage, when you have to sum it up and bring it all together, what the markets are doing, given the underlying macros, and how the currency is responding to it.
Oh dear, that's a mouthful. I think so. Rate cuts in India, that's a big shift. 5 years change, so people will need to get used to that. Maybe there's another rate cut coming at some point. People will need to adjust their portfolios as a result. China will likely, growth continues to shift down a little bit. This is a medium-term story. So China GDP growth will, over time, still be high, but just shifting down. Yields seem to have reached a point where the government doesn't want them to go that much lower. But there's a very positive flip side to that, and I have to say this here, is that the other big driver of share prices in China will be share buybacks. Over 40% of our portfolio companies are buying back their shares. And this is becoming a big driver. They're a big marginal buyer of the equity market. And the low bond yields and the low interest rates mean that companies can refinance at especially through the government facility, sometimes for 2%, 3%. So 2-3% money with earnings yields of 10%, that is incredibly accretive. So that powerful driver we see in the Chinese market. But growth will continue to shift down a little bit, and that means also, again, people need to sort of repick what they're long in that market.
And that's the important part, right, Gareth? Because there's a disconnect between markets and macros and the underlying growth. And then there's a currency picture, which is such an important core part of the export story coming out of China and India. How do you compare and contrast it?
Well, for us, we think largely most of the economies this year are going to be a little bit boring with regards to growth. It's going to be sideways action from the US, sideways action from China, from India. So we're going to be disappointed if we look back at the last 2 years, the kind of performance. But what we're wanting is predictable income. What our clients want is, where do we see some space where we're going to get the predictable income? So if growth is going sideways, if we think the currency is not going to deteriorate too much, they're going to cut rates or going to keep rates relatively supportive. To us, this gives us space to find in those niches. So as you highlighted, the idea that China corporates that can lend at cheap rates and then buy back, that is a great message. Where they're buying back, where they're building up, well, they're going to align themselves with the sovereigns as well. So we think that growth will remain relatively dull, but from a predictable income space, we're going to see more money coming out of places like Europe. Even very toppy exposure to US will start looking to allocate towards Asia. And if they're already full in some of the Singapores and the Taiwans, we think there's going to be more allocation to China and India. It's not just a case of going out of India into China. So we remain constructive on both, but very selective on India at the moment.
Great stuff, guys. Very constructive and balanced, and no black eyes. So really glad about that. But thank you so much for joining us here on this Friday. And yeah, it's been a really fascinating conversation. That was Gareth Nicholson from Nomura and Florian Whiting from Santa Lucia Asset Management joining us around the desk here.